which they haven't seen for many, many years, is to get the economy growing sustainably. And that means you have to bring down inflation. And that's why the Prime Minister's main pledge at the start of this year was to halve inflation. He has more than delivered that. Once you do that, once you do the hard work to squeeze inflation out of the system, you can start looking forward to the kind of growth that will see people's wages going up. On top of which, when we can, we want to bring down the tax burden so that people keep more of the money that they earn every month.
Well, joining me now is Liz Martin, Senior Economist at HSBC. Liz, good to see you this morning. I mean, call me a cynical old journalist, but it's rare to see a number this out of kilter with expectations. Is there any possibility that this is a rogue figure?
I mean, there are some things you could point to in this release which you might say are volatile. So computer games, for example, they tend to jump around a lot. They made a contribution to the downward move, airfares similarly. But no, I mean, broadly speaking, there is clearly a trend of disinflation in place. I think what backs that up as well is the fact we've seen it elsewhere. For example, in the Eurozone figure for the same month of November, there was a big and a surprising drop there. And encouragingly, you know, this is not just fuel, which we knew about, you know, commodities, shipping costs, those kind of things, but even services inflation is lower, has come in below, you know, seasonal averages. So it really does look like a broad-based disinflationary move, which I think is good news for everyone.
Now, the monetary policy has been quite sceptical in recent months that an easing in inflation genuinely represents an easing in long-term pricing pressures. Do you think this is going to change its mind at all?
No, I think it does. You know, there is a clear division between what's happening in the near term, the next couple of months, and what they think inflation will settle at longer term. And I think the Monetary Policy Committee have taken a view that inflation is structurally a little bit higher than we've been used to, and that high pay growth will keep services inflation in particular elevated. Now, you know, actually the latest wage number was a bit lower, so was the services number today. A few more readings like that might make them start to question that worldview. But, you know, remember, it was only last week we had 3 members of the Monetary Policy Committee voting to raise interest rates. Now we're talking about cutting them potentially 5 times next year. You know, I don't think they'll have changed their minds, you know, that decisively based on this one figure. But a few more like this, I think maybe we will see some minds starting to change.
Do you think the MPC is going to need to see more of an easing in wage inflation before it actually acts?
Yeah, I think so. And that's what Deputy Governor Ben Broadbent said in a speech he gave earlier this week. Ultimately, wage growth is still running at about 7% year on year. And that is not consistent with, it's probably double what's consistent with the BOE's inflation target. Now, it may be that it's turning over. I think it probably is. But there's also a couple of factors that will drive it back up again. One is the national living wage rising another almost 10% in April. The other is the new migrant salary thresholds. Those look like potentially being inflationary in terms of wages. So yes, I think wage growth probably has peaked and is coming back down, but a couple of reasons to think that it may not come down all the way to a level that the MPC is sort of happy with being consistent with the inflation target. So I definitely think that's what they've got their eye on in terms of forward-looking indicators.
Which is more important now, Liz? Is it the headline rate of CPI or is it what's going on with core inflation, which, of course, is still more than twice the bank's target?
I think it is core inflation. You know, if you look at what they say, the Bank of England says in their statement, they say that what we're looking at is services, core, the tightness of the labour market, wages, you know, because the bits around food and energy, they're the bits the BOE can't really do anything about. They're very much subject to global factors, imported costs, and the BOE policy won't make any difference really to them. The bit the BOE is worried about is what they call domestically generated inflation, and that is reflected better in the core measure. So as you say, still coming down sharply, still a big downside surprise in this morning's data, but still running at twice the level that would be consistent with inflation on target.
Now, Liz, wages growth is running at more than nearly twice the headline rate of inflation now. Is that going to generate much of a feel-good factor in the economy ahead of the election, do you think?
Well, I think to some degree, it's good news that after, almost 2 years of a really painful cost of living squeeze, that now real incomes are starting to recover. So, the pay growth is running higher than inflation. So people should start to feel a little bit better off. And actually, we see a number of indicators suggesting that the economy is almost starting to perk up. Consumer confidence has been up the last couple of months. The PMI activity surveys, the housing market is perking up. So I do think there's a little bit of a feel-good factor. Of course, we shouldn't get carried away. Everything's still much more expensive than it used to be, and that levels effect is still difficult for people to deal with. But yeah, I think, hopefully things are now on the up after a very difficult couple of years.
All right, Liz, got to leave it there. Good to talk to you this morning. Thanks a million.
Thanks, Ian.
Now, there's been much soul-searching about the UK stock market's attractiveness to companies after a clutch of businesses such as the tarmac owner CRH, the miner BHP, the packaging group Smurfit Kappa and the plumbing supplies group Ferguson moved their main listings overseas, and the chip designer Arm Holdings, of course, snubbed London for New York. Well, to that end, the Financial Conduct Authority has laid out plans today to shake up the UK's listing rules to make it more attractive for international businesses to list here. Among the main changes would be merging the standard and premium segments of the market. Well, joining me now to talk about this from the Financial Conduct Authority is Sarah Pritchard. She's Executive Director for Markets and International. Sarah, good to see you this morning. All being well, when would you hope to implement these changes?
Good morning. As you've said, these are the most far-reaching reforms of the UK listing regime in decades. We've set out our proposals this morning. They're open for feedback until the end of March. And depending on the feedback that we get, we're hoping to act at pace and have the new reforms in place for the second half of 2024. You may be familiar that we've already set out earlier this year some of the key changes, the move to a philosophy of a disclosure-based system, away from a system that requires shareholder votes in advance of large transactions and related party transactions. And so the proposals that you see set out today very much take into account the feedback that we've already received through the extensive engagement that we've had in the early part of this year. Crucially, we want to hear from people whether we have the balance right, and we will be engaging extensively through the early part of the next year.
Well, Sarah, you mentioned feedback. I mean, my inbox is bursting this morning with comments from asset managers that this is going to weaken corporate governance standards.
Well, crucially, as I said, one of the key changes here is a move away from shareholder votes in advance of big transactions and related party transactions to a philosophy that's disclosure-based. But crucially, we're looking to make sure that the right information is in the hands of investors so that investors can make their own decisions on companies to invest in and hold companies to account. As we've said, we want to make sure that we have the balance right. This is a rebalancing of risk, which is why we want a public consultation and engagement on it. In our earlier feedback earlier this year, that philosophy, moving to a disclosure-based system, similar to some other international jurisdictions, is something that has been broadly supported, but we want to hear as to whether we've got the balance of measures right.
I do note in your statement you admit these proposals may lead to more corporate failures.
As you say, we have publicly acknowledged that this is a different balance of risk here. We're hoping that ultimately this will lead to a wider range of companies for investors to invest in. But clearly, in enabling differing sorts of listing regimes, a focus on disclosure, this is a different balance of risk, which is why we want to make sure that we are focusing on getting the information, the right information to investors, and retaining the key role that sponsors play as gatekeepers here, and retaining shareholder approvals required for delisting and reverse takeovers. As I said, we want to hear from you. We want to hear whether these proposals work in the way that we've anticipated, and we're already reflecting feedback from earlier this year.
You've touched on the fact that you're proposing to scrap the requirement for shareholders to approve related party transactions. Do you think if that was already in place, then the UK might have had a better chance of persuading Arm Holdings to list in London rather than New York?
I should just say up front, this is never about one particular company. This is about making sure that we have a regime that is. We've heard feedback that there are certain elements, so many decades ago, there are some elements of that regime that make the UK not an attractive proposition for corporates deciding where to list. There are clearly other ranges of factors at play, but this is us as a regulator playing our role in ensuring that we can support UK competitiveness and growth. As I said, though, we really want to hear your feedback. We want to know whether we have the balance right. So please do let us know what you think.
Sarah, isn't the problem here not the listing rules themselves, but the fact that by and large UK pension funds have completely turned their backs on UK equities?
You're right to say that we see companies having an increased choice as to where to list. We also see increased global investors in the UK, and data shows that UK pension funds and insurers have only held 4% in UK equities within 2022. So they are already exercising choice in different jurisdictions which have that philosophy of a disclosure-based system. That is something that we have seen a reverse trend from UK investment in UK equities by pension funds and insurers in the UK over the last decades.
All right, we have to leave it there. Sarah, appreciate you joining me today. Thank you.
Thank you for having me.
Some other business news stories for you now. And Shell has given the go-ahead overnight for a deep-water oil and gas platform in the Gulf of Mexico. The oil major and its partner, the Norwegian energy giant Equinor, said production would begin in 2028. The development, called Sparta, will be Shell's 15th deep-water project in the Gulf of Mexico. It's expected to achieve peak production of around 90,000 barrels of oil equivalent a day, and it's estimated to have a discovered recoverable resource volume of 244 million barrels of oil equivalent a day. The FTSE 250 pharmaceuticals company Indivior this morning resolved a patent dispute with Actavis Laboratories. Under the agreement, Indivior, which is a market leader in products used to treat opioid addiction, has granted Actavis, which is an arm of the Israeli generic drug maker Teva Pharmaceuticals, a license to a US patent that will allow it to launch copycat versions of two of its film products. Shares of Indivior, which was spun out of the household goods giant's Reckitt a decade ago, have risen by nearly 4% on that news. Shares of Petrofac surged by more than 56% at one point this morning on news that the Energy Infrastructure Services Group and its partner Hitachi have won a second contract with the Dutch-German transmission system operator TenneT. Petrofac's portion of the second contract, which is part of a $14 billion multi-year framework agreement to expand TenneT's offshore wind capacity in the North Sea, is valued at around $1.4 billion. The company said it was entering 2024 with an order backlog in both traditional and renewable energy of around $8 billion, reflecting strong order intake in both engineering and construction solutions. Well, the pound fell sharply on the lower than expected inflation figure this morning, while gilt yields also fell as investors began to price in an earlier Bank of England rate cut than previously. The pound currently off by just over 0.5% against the US dollar. It's off by 0.25% against the euro. The single currency, meanwhile, off by 1/3% right now against the dollar. On the equity markets, after Wall Street's strong showing last night, in which the Dow hit a fifth consecutive record close and the S&P 500 finished 1% off its all-time high, there was mixed trading overnight in the Asia-Pacific region. Once again, the highlight was the Nikkei in Tokyo. That hit its highest level for more than 5 months following the Bank of Japan's unexpected dovishness on Tuesday. Nikkei finishing up 1 1/3% right now. In Europe, here's how stocks are trading just now, all trading to the downside with the exception of the CAC 40. Talking points this morning include Telefonica, which is ahead some 3 3/4% in Madrid after the Spanish government said it would buy a stake of up to 10% in response to Saudi Arabia's STC buying a 9.9% stake in the telecoms operator. Well, the one exception majorly in Europe this morning is the FTSE 100, up by just over 0.5% on that inflation data. It's led by property and consumer stocks and is currently close to a 7-month high. In percentage terms, the quality assurance services provider Intertek is the leading gainer this morning. It's ahead by some 3.5% on support from one of the brokers. Outside the FTSE, stocks with consumer exposure are again among the leading gainers. They include Currys, which is more than 3% to the good. There's Intertek, which I mentioned a moment or so ago. As for the oil price, well, that has risen above $80 a barrel for the first time since the 1st of December. That's, of course, on the situation in the Red Sea, where a lot of shippers are diverting tankers elsewhere, notably BP, of course. Barrel of Brent crude will currently set you back $80.08 a barrel. That's up just over 1% this morning. Well, joining me now is Anna Stupnitska, global macro economist at Fidelity International. Anna, good to see you this morning. I mean, the inflation number, clearly a big surprise. I've noticed how people are now repricing their expectations on interest rates. I mean, the market is now looking for a rate cut in the first half of next year. Is that likely?
Yeah, the market keeps getting Christmas presents, early Christmas presents from the policymakers and from the data. And as we know, the BOE was quite hawkish last week, but now seeing this big surprise in inflation, the markets are trying to get ahead of the game and try to price more. Now, it's important to note, I don't think we are out of the woods yet on inflation overall, particularly in the UK. We have core inflation still pretty sticky, wages are growing, and the policymakers will need to see more evidence before they start cutting. So yes, the markets are pricing in, I think, pretty much all three central banks now starting in March and cutting by 5 or 6 cuts through the year. I don't think it's likely, particularly for the Bank of England.
No, and that's a really crucial point because, I mean, we've had this in the US and to an extent in the Eurozone. The market's expecting more interest rate cuts than certainly the central bankers themselves are indicating they're likely to deliver. And now the Bank of England is in this same position. Are we going to have to start seeing the likes of Andrew Bailey and his colleagues jawboning down the market and sort of trying to dampen expectations?
It's possible. You see, the Fed was quite dovish last week, and now a lot of the Fed speakers are coming out and trying to push against the very early market pricing. They don't want to get the markets so much ahead of themselves. But then they didn't push back on that market pricing last week. So that's fueling the speculation that they will cut more. I do think that the BOE will have to now clarify the stance. They're hawkish, but maybe the least they can do in light of this data is perhaps remove the tightening bias and move the policy to a more neutral stance and say, well, we're still data dependent, we still need more confirmation that inflation is going down. So I do think we will see some fine tuning from the central bank speakers over the next few weeks.
Yeah, I mean, the market is now pricing in 120 basis points off bank rate next week. That would take bank rate down to just over 4% by this time next year. That really isn't going to happen, is it?
Well, I think it is possible if the UK economy goes into a more sort of pronounced recession. It's now stagnant or growth is negative, maybe on the brink of a technical recession. Now, as we move into the next year, if the Bank of England doesn't start cutting rates in the first half, we might well see that weaker patch of growth, and then they will have to do a quick course correction later in the second half. So right now, this pricing is relatively smooth through the year, early start, 5 or 6 cuts through the year. But I think a more likely scenario is that we see nothing in the first half and then a rapid cost correction, if inflation allows, in the second half.
That's very interesting, Anna. There's loads more I wanted to ask you, but we're out of time, I'm afraid. Good to talk to you this morning. Thank you.
Thank you.
Still to come here on Business Live. We'll be speaking to Tony Darwood, the head of Gresham House, on the day the company delisted from the stock market. Don't go away.
They've pushed the protesters further back here. There's around 200 or 300 still remaining.
I'm Dan Whitehead and I'm Sky News' West of England correspondent.
This van goes onto the streets of Plymouth 7 days a week, 365 days a year.
These facilities at the moment are a lifesaver. It's all we've got.
From fishing communities to bustling cities, we spend every day reporting from across the region, hearing from people who have real stories.
I'm gonna have nowhere to live for about 3 or 4 months.
There are still people inside the properties here. They're coming from the epicentre of what is now a global health pandemic.
We were seeing and speaking to young women who were selling themselves right on the high street. It was desperately sad, and the fact it was happening right in the heart of this community. Before Brexit, these oysters were being exported to the EU, but the trade stopped overnight. your feeling about the future then?
Blake might all be finished, I don't know.
Fly Emirates, fly better. Fly Emirates, fly better.
Thank you.
Welcome back. Now, today has seen the delisting of Gresham House, one of the UK's leading alternative investment managers. The company, which dates back to 1857 and which specialises in forestry, new energy, sustainable infrastructure and affordable homes, has been bought by the US private equity firm Searchlight Capital for £470 million. Well, joining me now is Tony Darwood, the Chief Executive of Gresham House. Tony, great to see you. Obviously, Gresham House, strongly associated with sustainable investment. Will that continue?
Without question. Lovely to be here. Thank you very much. Yeah, it's really exciting times. I like to think that Searchlight are going to back us. They are going to back us on our strategy that we've set out for the next 5 to 10 years. Importantly, they're staying with the management and the strategy that we've outlined, which is increasingly now we want to focus on internationally, build our asset classes both in depth and breadth. And I think that's a really important thing. I think it's really notable that people talk about the UK stock market and the doom and gloom of that and the number of companies delisting. But we are arguably a success story, and we've accessed capital 9 years ago. We grew the business from £15 million market cap to just under £500 million market cap. And we're a business I think the British and the Irish can be proud of now. We've got very strong market shares in those sustainability areas that you talked about, particularly battery storage, energy transition, huge in forestry and natural capital, increasingly in sustainable infrastructure. And one thing I'm very proud of, I've talked with you before about, is the growth companies in the UK and Ireland and accessing venture capital money. We're number 2 in venture capital trust market in the UK. We're really proud of those things because this is the start of the next leg. We want this to scale. The ambition over the next 5 or 6 years is considerable. So it's an exciting chapter.
In terms of scaling up then, which are the markets that you might be addressing more aggressively in future?
All of them will be a focus for growth. Some will have more of a focus in terms of international and M&A. So the access to capital we've now got, one of the reasons for potentially delisting is the potential to access capital in order to accelerate our growth, accelerate our sustainable infrastructure, accelerate our energy transition, and our forestry natural capital. So those are the areas you can expect super normal growth.
I think Searchlight Capital have said they want you to double assets under management. By when are they looking for you to do that?
Well, like most people, and in my language, I like to have done it yesterday, but we're going to aim for that over the next 5 to 6 years. But we have a 10-year plan beyond that. So it's important that our clients recognise we're here for the long term, not just the next 5 to 7 years.
Obviously, you've benefited, some would say, from ultra-low interest rates over the last decade. In fact, the Lex column in the FT said higher interest rates are now taking a lot of the air out of the bubble in ESG-related investment. What do you say to that?
2 points. One is it's a structural growth market. The recognition of decarbonising the environment to make the world more sustainable is a structural phenomenon. And even those states that recognise that fossil fuels are part of their fabric, they recognise that over the long term, sustainability is a theme that has to be pursued. So we perceive that this stabilisation, we've seen stabilisation of interest rates, will lead to a restarting of the engine of growth and sustainability. But no, I think the sustainability agenda is here to stay, and we are going to be part of that.
Obviously, as you say, you're the second largest VCT manager in the UK. There's been it's been a tough market for venture capital this year. Do you see any signs of, a bit of sunshine on the horizon?
Yeah, well, my horizons are long term, right? And you need to invest in these areas. The UK has been a phenomenal engine for growth for 200 years of startup companies and entrepreneurialism and culture. The venture capital trust market and venture capital is part of that. So I feel very optimistic about the long term. It is essential, and actually, Barron's Mead is one of our brands and they've started fundraising recently, and that fundraising in the last 2 weeks has gone very well. So I would say, yeah, I'm very optimistic, and it's essential for the fabric of this country and Ireland in order to grow.
Okay, are you going to miss being a CEO of a listed company?
There are benefits. It helped us build the brand. It helped us to incentivise all the way down the organisation, all the way down to the PAs that own shares in our business, which I'm really proud of. We will replicate that in the new world, but it's lovely to see their smiling faces as they make money out of some of the things that they work in. So missing some of the shareholder meetings, I will miss some of those. Some of them I won't. And but I think the future is one where I'm excited about. And you never know, maybe back a much larger business back on the stock market and have some more exciting times again then.
All right, Tony, it's great to have you in the studio today. Hope to see you again in future. Thank you. That's it from me. I'll be back with our afternoon edition at 4:30. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, Jane Secker will be back with you. Hopefully see you later on. Cheerio.